Can you guys hear me?
Yep.
Okay, good. Okay. I think everybody's here. Um, I think everybody's here. All right, so today, I guess not. Okay, now everybody's here. All right, now we can get started, think. So, can you guys believe that there's only two more sessions, and then it's your midterm? I mean, your final.
Yeah, it's crazy.
Yeah, it went by fast. Remember, I told you guys it was gonna go by fast. It did. Uh, so I don't know why it's doing that. I may need to reboot my laptop. We'll see. Um, all right, so let me hit record. All right, so we're going to continue our discussion of property transactions today. That's all we're going to focus on today is property transactions. So we're going to deal with the Section 1031 transactions today, the like-kind exchange transactions, um, and then that would be it today. What is today, by the way? Today is something. I don't know what it is.
It's tax day.
Tax day. So I got to get back to work eventually. Well, continuous work day today. At some point, I have to try to run. Maybe we'll see. But we still got work to do. So again, today we're going to do a quick review of the non taxable exchanges sales. We'll quickly review those. We're going to focus today's attention to like-kind exchange problems. We're going to revisit that problem from Brightspace, and we're also going to do the problems from chapter 15. And then again, we're also going to focus on 1231 sell fixed assets. Again, that's going to be on the final. So I gave you a brief preview of what the final is going to be last session. So keep that in mind. Hopefully, you guys took notes. I'm not going to repeat it today. Hopefully you guys took notes last week when we went over that, or last session, I should say. And again, you got a practice quiz that's due for your quiz 3, and that's due Monday. So make sure you work on that over the weekend, and that's going to be cumulative. That's going to contain problems from everything we covered up until today. Next week, what else are we going to do next week? Again, next week we're going to do the review of the quiz week and on Monday, and then we're going to tie loose ends with property transactions. But I think with today, we should be already comfortable with property transactions. Next week, we're also going to talk about tax credits or continuation of tax credits and additional taxes. I'm not gonna test you on that on the final though. The only credits that I'm gonna test you on is what we've covered already, which is a child tax credit under the age of 17, and the credit for other dependent, which is the credit for other dependent. Again, as long as they qualify for qualifying child or qualifying relative, they get that $500 credit. That's what I'm going to test you on. I'm not going to test you on the education credit, the retirement savers credit, dependent care credit. I'm not going to test you on any of that. But I will go over that next week. Just enough for you to be familiar with the tax credits. Tax credits do change constantly, quite a bit actually, and but we'll go over it nonetheless. Now, are you guys ready? Oh, I didn't hit record. Sorry. All right, I can hit record now. Record to the cloud. All right, now we're
Arnold,
recording. Go ahead. Who was that?
it's me, Margaret.
Yes.
Um, I started working on the text research problem, and I'm having problems getting access to the research site checkpoint.
Well, you need
Uh,
remember several weeks ago I said you need a subscription for that. When you buy the textbook, there is the textbook that has the subscription, the 6 month subscription. I don't know if you have that textbook. If you do, you should have been provided with a username and a password. and that would have been included with your textbook. If you bought the textbook that did not include that, then you can't use the checkpoint. You would have to do it the old-fashioned way, the way that I showed you how to do it before, going through the IRS website or going through Cornell Law School website. At this point, again, you should already have done a lot of the research. A lot of the code sections that I've given you, it's there. Again, you don't necessarily need checkpoint, but it does help. It does help. But a lot of the code sections that I've given you, I've pretty much already given you the answer. If you think about it, you just have to know how to, you know, get your thoughts together, recite the right sections of the code, and put it together. And so there is free access. Again, Cornell Law School. Again, if you just search for it, type in Internal Revenue Code on Google, it should take you to Cornell Law School. Again, in terms of income tax, that's Title 26. So make sure you enter that correctly, and then you should be able to, enter the correct, section. There used to be a way accessing it through the IRS website, but again, it's backdoor. It's the IRS website, then it goes through the Cornell Law School. That's the free version. But again, if you bought the textbook that came with the subscription, you should have been provided with a username and password.
So I did buy the textbook, and inside there's a page that says it comes with 6 months.
Yes, yes.
But there is no code. Did that come on a separate card? I didn't.
Oh, you should have.
Other students.
The card should have been in there. They should have been the card. I know exactly what you're talking about. The card is in there. They didn't give you a card?
No, I didn't get a card. There's a page in the book that says it comes with 6 months, but there is no card. It did not come with a card. Any other students, how did you receive the code?
Is this a physical textbook or electronic?
It's a physical textbook. It's a hardcover.
Okay, I don't have that. Sorry. I think someone said before, Mia, was it you that if you get the electronic one, you don't get the checkpoint?
Correct. If you get the electronic, if you get the online book, you don't get it. But if you have a physical one, it's like it's a couple pages in, and you can see like the subscription, the username, and the ID.
Okay, cool. Thanks.
Yeah, I'm looking at the hard cover. I'm looking at to see. Yeah, it's right there. It's within a couple pages. Again, here's I don't know if you guys can see. This is the one that I have. Can you guys see?
Yeah, that's exactly the one. Yes, that's the one I have. Where on which page am I?
Again, it's within a couple pages. Again, that's the first page. And then right here, you guys see it? Where it says checkpoint, that's the page.
But there's no code on it.
And see the code on the bottom? I don't know if you guys can see, but I don't know if you guys can see, but there's the code on the bottom. That's the card. That's the card that you should be getting. That has a user ID. Did anybody else get that when they bought the textbook? Yeah, I don't know how it would be with the electronic version of it. I'm not sure if it would be, if you'll be able to get access to that. But if you bought the hard copy with the subscription, it would be there. It would be unless they took that page out.
I have that page where it says checkpoint. It says 3 simple ways checkpoint helps. But on that page, there is no user ID or password.
You need to call them. You probably need to call them. You would need to call Cengage so they can give you. Yeah, because mine has it right there.
Yeah, if you bought it from a second-party seller, they may have taken that to sell elsewhere.
No, I bought it from the school bookstore.
Yeah, then they should have given you that. I don't know what to tell you. It should have been there. To see if it gives you instructions on contacting Cengage. But yeah, you would need to do that as soon as possible. And they should be able, there should be a number where you can call them, and then they'll direct you to Checkpoint, and you should be able to get the password. But it's that page that you're referring to on the bottom. It should give you even the code and the username, and you can change it once you access it. And then that should be it. It should be pretty simple. Yeah,
I think you can also get a free trial.
You can get a free trial.
I think you can submit like a form if you fill out all of your information, and it might give
Yeah,
you it for like a week or so.
yeah, I saw that on the website.
That might be worth a try in the
There you
meantime.
Oh,
go.
that's
Just
good
to,
to know.
Thanks, Dan. Was that Dan?
yep.
All right. Now you got me thinking. You get what? Maybe they're just that's new. I'm going to their website. Hold on. Let me share the screen that I have, so you guys can see. All right. So it's um. All right, can you guys see it? Okay. So this is the access page. Ignore this information shouldn't be there. That's something else. Oh, free trial, right there. Free
I don't
check.
know how quickly you get it though. Like somebody from their sales team or something might like reach out to you, or it might give it to you right away. I'm not sure.
Yeah, I'm not sure, but it's worth to try. Um, the one person that I have worked with, and but she doesn't handle education. She handles other stuff. I don't even know if she handles Cengage anymore. Her name is Tammy Brazil. Um, Again, she was the representative to handle a lot of the tax products from Checkpoint. I don't think she does the Checkpoint, but she does do other research material. They may direct you to her or somebody within her department. But yeah, try contacting them. But somebody will contact you. They are going to try to sell you the subscription. But just so you know, not there's no such thing as a free lunch, as they say. I mean, it is free, but then they'll say, well, they'll sell you everything, but you don't need everything. If in the subscription, just tell them you need the basic tax research. You don't need all the bells and whistles. It's the basic primary source of tax law. That's pretty much all you need, and the tax guide. That's pretty much all you need. Basic secondary sources and primary sources, and that's just the base product. Telling you need the base product. That's what you're trying to, review, and they should be able to give it to you. Again, I'm not sure how long it'll take them. So, but it's yeah, you're crunched for time. This is like what do they call it? 11th hour, type of scenario.
Yeah,
Uh,
I know.
but yeah, it can be
Oh,
done.
it's like 10 o'clock.
Okay, okay, maybe not. So it's the 10th hour, but you're close. There's still some time. I mean, you got the whole weekend. Try this, but if not, just do it the old-fashioned way. Go to the Cornell Law School, and again, you got the code section. They're giving you the code section, or use a book. Remember, I said you can use secondary sources. Use a textbook, and then try to find the answer that way. The textbook is very good. If you notice when you're reading the textbook, they give you the citations. If it's a court case or code section, the citations are on the bottom. So it gives you good reference material. I like the textbook a lot, but this textbook is good in providing the appropriate reference material. Again, all I'm looking for is primary sources, code sections. That's it. Now, if you find a case or something in the administrative sources, I'm not looking at anything specific in the administrative sources. I'm looking for statutory, just code sections. That's it. Again, if you find something in administrative and judicial source, that's fine. You can use secondary source, but as long as the paper is focused on primary sources of text law, I think you guys would do well. Again, you guys got the answer. If you really think about it. If you look in your notes, I guess that's the best way I can tell you. Look in your notes. That's the best way I can tell you. Look at the textbook. You have the answer with you. Again, take a position. Stick with a position. Don't just say it could be this or it could be that. Whatever the position is, sell the position, support your position with substantial authority of tax law. That's what I'm looking for. There's not really a right answer. I mean, there's one answer that I prefer, put it that way, but there's no right or wrong answer. There's one position that I would prefer, and then the funny thing is, I guess you can also make the argument against that position with pretty much the same code section. That's one thing I want you to think about as well. You can pretty much use the same code sections or the same sources, and two different people can actually arrive at the different conclusions. And if the code section or the case law can be clear, as some people would say, but not so much because it's open to interpretation. And that's even like true with even with a lot of things that are going on right now. Like sales taxes, the welfare case. is one. And even with cannabis cases, there's a lot of cannabis cases. Depending on where you go, they would interpret that differently. So again, everything is subject to a different interpretation. We talked about a couple cases here. We talked about the professional gambler case, the Grosinger case. That could be interpreted differently depending on who you ask. And then remember that whose income is it anyway? The fruit of the tree doctrine. I cited a couple section cases there. So there's a lot of cases, and depending on who you ask, you can get more than one position. As long as you cite the correct authority, that's all I'm looking for. Cite the correct authority, primary source, and as far as don't focus too much on getting the right answer because there really isn't. There's just one answer that I would prefer, one position that I would prefer, and then there's the other position. But either way, it's not that you're wrong as long as you support your position. That's what I'm looking for. Cite primary sources of tax law.
Thank
That's
you.
all that I can say about that. And good luck. I'm sure again the tax. I'm sure you guys had fun with the tax return project. Now you have the tax research assignment, and then you got your final. So keep in mind, including today, start asking me questions today. Again, today I'm not going to cover any new material today. It's the stuff that we covered the last few sessions, property transactions. Like I mentioned before, we're going to focus on like-kind exchanges and 1231 transactions. So that's what we're going to get into first. So there's several problems, and then I'll leave it open for any questions, and then we can go home. We'll probably leave early today. We'll we'll see depending on how far we get in the material. But again, we're not going to cover anything new today. It's just property transactions. All right, are you guys ready? Property transactions. Let's do okay, quick review of what we covered a few sessions ago. A couple sessions ago, we talked about well, actually last session. Um, we talked about non-taxable exchanges. Again, I'm only going to focus on the important concepts, the ones that I'm going to test you on. Now, in this particular section, what I of course, the equation or the questions that you need to ask. What is the realized gain or loss? What is the recognized gain or loss? That's what's reportable. And if there is a recognized gain or loss, what is the character and loss? And then for like-kind exchange transactions, we're dealing with what is the basis of the new property. We'll go over that as well. Now, again, Section 121, remember that sale of exclusion if you sell your personal residence, $250,000 for single head of household. For married taxpayers, $500,000. Remember, you have to meet the two out of the last 5 year test. As long as you used it and owned it and use it as your personal residence, you'll be able to exclude the full amount. There are, if you fail to meet those 2 years, so if you kept the house for 1 year, then you're not eligible for the exclusion. If you kept the house for a couple months, you're not eligible for the exclusion, except if it's a special circumstance. Again, you're forced to sell your house under special circumstances, change of employment, health reasons, unforeseen circumstances. I would guess that's probably happening a lot in today's current state. Um, in that case, you're just going to prorate it. The partial exclusion is available based on the time used, so it's going to be months over 2 years. So think about, let's say I kept the house exactly a year, and I was forced to sell it because I lost my job. So 12 months out of 24, so that's half. So I'll take half of the exclusion. So 125 if I was single, and 250 if I was married. So that's how that would work. Again, we talked about in terms of the taxpayers, married taxpayers. I'm not going to revisit that. Um, that's it for that part. Again, self-personal residence, that's a capital asset. I do talk about Section 1250 in here, Section 1H, the recapture, unrecapture provisions. If you're selling rental property, you always have to recapture the depreciation at a different rate. So it's not all capital gain. A portion of the depreciation would be taxed at a different rate, up to 25%. So that's that rule, the 25, the recapture provision. Now I talked a little bit about, what if I kept my house for 3 years for personal purposes, and then I rented it for 2 years, the last 2 years. So out of 5 years, I rented it for 2 years, and that but I use it as my personal residence for 3 years. I'm eligible for this exclusion because of the 2-year test. What I'm not eligible for, well, there's still recapture provisions under 1250 and 1H that talks about any depreciation claim can be taxed at up to 25%. So even though I'll be able to exclude a portion of the gain, the depreciation that I did claim or should have claimed, that's taxed at up to 25%. That's how that works regarding when it's rented a portion of it. And even for vacation properties, if it's a vacation home, remember there's depreciation on vacation homes, so this rule applies as well. Now the like kind exchanges, again, remember it has to be an exchange. Selling and then buying another property is not an exchange. Again, it has to be an exchange. And then in terms of the specific rules, did I tell you it has to be an exchange? I think I said that a couple of times. So again, selling and then buying another property, that is not a like kind exchange. It has to be an exchange. The reason why I keep repeating it because so many people misinterpret that. What they do is they sell their house or they sell a rental property, then use the proceeds and reinvest in another property. That is not a like kind exchange. That is a sell of a property and a buy of the purchase of a property. Two separate transactions. A like kind exchange has to be one transaction. We talked about specific rules that allows you to use a third party, to facilitate the transaction. These are known as third party or three corner like kind exchanges. But as long as these the criteria are met, the 45-day period to identify the property and 180 days to actually receive it. And it's 45 days from relinquishing your property and 180 days from relinquishing your property. That's when the time starts. Amount realized minus adjusted basis. We went over that equation. Again, we're going to revisit that problem, the like kind exchange problem that I showed you. Again, remember the formula. We'll do that in a few minutes. Okay, that's it for this particular page. Again, I do want you to know the rest of the notes, but right now I'm just focusing on the what I'm going to test you on. All right. So last session we also went over. We also went over 1231. No, that's not it. 1231, 1245, 1250. And what's all that? What does that mean? Um, I don't know. I just like saying code sections, random code sections. Section 1231, that's a fixed asset, right? Remember, again, this handout is on Brightspace, so where it talks about netting the two 1231 gains with 1231 losses, and then what happens. Again, remember, 1231 has the best of both worlds. Gains are treated as capital, long-term capital gain, and losses are treated as ordinary. But that's not necessarily the case. Remember when we went over last week when we talked about the depreciation rules? Now the book has a similar table than what I have right here. It's very similar. You'll see similar tables to this, but it's the same concept. Notice that on the 1231 losses side, so if you sell a fixed asset at a loss and that's all you sell, if you follow, again, 1231 loss, then you're still at the 1231. It's treated as ordinary, right? Again, 1231, sell it at a loss, it's treated as an ordinary loss. Makes sense, right? And over here on the left-hand side, if you sell it at a gain, there's a couple hurdles that you have to cross before you even get to capital gain. Again, that's a mistake that people make is they say, well, I'm selling a fixed asset. How much capital gains do I pay? Well, it's not all capital. Some of it is depreciation that you're recapturing as ordinary income or at up to 25%, depending on what type of asset you is. Okay, so 1231 gains. So the question is, do you have any depreciation? So pretty much all fixed assets have depreciation. So then you're going to apply 1245 if it was a personal T asset, again, machinery and equipment, or 1250 if it's a real T asset. And then even if you still have a gain after you apply the rules, then it goes to a 1231 gain. Then you offset it to the 1231 losses. If there's no 1231 gains, 1231 losses, then it continues. again, you have a gain here, then you apply the recapture provisions, and then you end up with a gain. Well, then you ask yourself, well, how am I going to treat that gain? Before you even apply the capital gain rules, the section 1231 loss, you have to ask yourself or ask the taxpayer, did you claim 1231 losses or as ordinary losses in the last 5 years? If so, those losses up to the amount that you claim would be treated as ordinary income. So again, it's even I want you to think about this for a second. When somebody tells you I sold a fixed asset, rental property, or anything that's, or even if they sold a personal residence, they rented a year or two. Same concept. You have to walk through these multiple steps before you even determine if it's something is considered capital. It's not by default is considered capital. You have to walk through it. Again, if it's a 1231 asset, a fixed asset, you have to walk through all these steps. If it's just a capital asset, then capital gains, capital losses. But Section 1231 is very complicated because, again, the losses are ordinary and the gains could be capital. But even before we treat them as capital, we have to apply the recapture provisions first, the depreciation recapture, or the ordinary income provisions and the ordinary losses that they claim in the prior year. Now, the 1245 rules, back to this again. I'm going to focus on 1245 and not 1250. I want you to read 1250 on your own. We're going to revisit this later. But what I want to direct your attention to is the 1245 recapture provisions. Again, it applies to personal T, not personal use asset, personal T, meaning machinery that you use in business, autos that you use in business, furniture, or any fixed asset that's not realty. Again, if it's sold at a gain, then any depreciation that you claimed must be recaptured as ordinary income. So 1245 is actually pretty complicated. I mean, pretty simple when compared to 1250. 1250 is more complicated. For 1245, any depreciation up to the amount of cumulative depreciation, that's ordinary income. Anything in excess of that, number three, that's a 1231 gain. And then you take it a step further and ask the taxpayer, are there any losses in the last 5 years? 1231 losses. If the answer is yes, then you're going to recapture it as ordinary income. 1245 capture provisions does not apply to any losses. Now, in terms of 1250, again, just quick overview. This is realty. Now, the part that I'm going to highlight, this is the more relevant part. The first part, not to say that it's not relevant, uh, because accelerated depreciation is not available for realty and it hasn't been for decades, letter A is not really applicable much to a lot of taxpayers. It is relevant, but it's not applicable to most taxpayers. Most taxpayers use straight line depreciation, which means the straight line depreciation up to the amount that you claimed or should have claimed, the allowable or allowable rule, that's taxed at up to 25%. And that's known as unrecaptured depreciation. So, in terms of realty, so that's you may hear that term tossed out a lot. That's what they're talking about. The unrecaptured rule is the straight line rule, which it means it could be taxed at up to 25%, not at 25%, up to 25%. And then any remaining amount can be 1231 gains, and then you go through that step. If there are any 1231 losses in the last 5 years, if so, it's recaptured as ordinary income. Again, this is a quick review of what we covered last week. Let's do the problems. Proper transaction problem. Okay, give me a second. Property. All right, so remember these problems. I hope you guys are reviewing these. These would help you study for the final. We're not that one. We already did that one. We already did this one. Highlights on this one. Again, I'm not going to show you the answer, but a quick highlight. I went over this last week. Letter A. What was the result of letter A? Somebody give me the answer for this one. Again, they sold. It's a personal residence. Bart sold his personal residence that he kept for 8 years never rented it, so there's no depreciation, recapture, or unrecapture rules applicable. So what happened in the first scenario? He sold it for 350,000. You guys remember? I went over this a couple of days ago, so it should be fresh. Let me pick on somebody. Hannah, are you there?
Yes, I am here. I'm not sure right now.
Okay. Matt. No, not Matt. Gabby, do you know the answer for this?
So he doesn't have any gain
Why?
because it was $100 the value plus the 50 of the improvements, 150, and then he sent 200 because it was a personal residence for more than 2 years.
Right. So the realized gain, you're right. The realized gain, there was a realized gain of 200,000, right? But that's all excluded because
Yeah.
you're right. You're absolutely right, because he's kept it for 2 out of the last 5 years. You're absolutely right. Not all of it is excluded. There is a realized gain, but it's excluded, so there's no recognized gain. It's excluded under Section 121. Pretty good. So letter B, Matt. You want to go, Matt, for letter B? Matt, are you there? You're here twice. Matt.
I am here. Sorry. Two different devices. One's doing the recording. I thought we were supposed to do the like-kind one, and that's the one I did most recently.
Okay, but this is also, we went over this as well. But this one's actually pretty simple. Very simple. Who else? Let's see who else is here. Mia. You're here. I see you there. Mia.
Yeah, I haven't watched the last what's the name, and I wasn't in class.
You weren't in class last session.
I wasn't.
What I want to tell you, right? You're responsible for getting notes from a fellow classmate for any session.
Yeah, I got it.
But no, I get it. It's the thing is about the summer semester is a bit tough for I mean, you guys students, because it's back to back. You're doing classes Monday and Wednesday or whenever it is, and you miss a session, you miss a lot of material, and it's tough. I don't see how you guys do it. I'm gonna give you guys credit. It's I don't think I would take me as a teacher in the summer. I'm gonna be honest with you. I would do something else. I would still take me, but I want to take me for the summer. All right, Dan, you're here, right?
I'm here, but I'm gonna get the same lecture she just got.
Weren't you here last week? I thought you were here once.
No, I had a family emergency. I missed the Monday class.
Okay, so ditto. What I just told
Can I
you.
try it?
Who is it?
Gabby.
All right, go ahead, Gabby.
So Bart's gain, based on what you previously explained to me, it will be 450 because we deduct the 150 of the value and the improvements. But
it's not value; it's the cost plus. But you're right; it's it's the basis. Call it the basis.
Yes, and then the recognized gain will be 250 because the 200 are excluded because it was a personal residence.
You're right, except for the last part.
Okay.
How much can he exclude? Not 200,000. In the first scenario, it's up to 250,000, but the first scenario he only excluded $200,000. Letter B, it's up to 250 for a single.
200.
So in that case, it should be 150, right?
Okay. All right. No, 6.
So 600,000 minus 150 equals 450.
Minus 250.
Minus 250 equals 200. Okay, you're right. So minus the 250 equals 200,000. Right. Is that right? All right. Well, again, I don't have the answer with me, but that's again.
But can you explain that one more time? So you're taking the 600,000.
The amount realized, yes.
Okay, and then you're subtracting from that the basis.
Yes.
Okay.
Remember this is the equation that I gave you way back in week when we covered basic property transaction rule, and that's always going to be the equation. Selling price, which is your amount realized or your consideration, minus your adjusted basis, the basis of your property. So yes, it's
Okay.
the
And then
600,000.
you would subtract the 250,000 for the exclusion.
Only for this scenario because it's a personal residence. Again, I want to emphasize that the 250 and the $500 is only available for personal residence, not available for fixed assets. So again, if you sell a rental property, if you sell a vacation home, then that goes back to the 1231 rules. Then you got to see if how much depreciation is recaptured under 1250 or unrecaptured on a 12 or actually 1H, and tax that up to 25%. So again, this is only for personal property. Letter C. Letter C, they sold it at a loss, right? 40,000 minus 150. What does that equal? Well, whatever it is. Yeah, $90,000 loss. Matt, what do you think happens there? You know the answer to this. I know you know the answer to this. They sold a personal use asset for whatever the loss is, $90,000. Do they recognize that loss? I know you know the answer to this. No, it's personal. Very good. It's personal loss, and can't deduct it at all. Again, the only issue that we have in terms of character, letter B, whatever the gain is, it's a capital gain because you're selling a capital asset, right? Again, the answer is on Brightspace. Take a look at it. Again, I will ask you a question on this on the final. Oh, like-kind exchange. Matt, I think you wanted to talk about this, right? So first, actually, Dan. Well, no. First, I want to pick on Mia. Mia, who is George F. and Evander H? Just take a guess. Do those names sound familiar? I'll give you a hint. They were popular in the 90s.
You could make a panini.
Oh yeah, that's something. That's his new product. That's well, George Foreman. George Foreman. George Foreman is no longer a boxer. He's an entrepreneur. You know, they're both entrepreneurs. But George Foreman, what was that grill that he had? What do they call it? It's that grill that was a slant. Actually, I had a couple of these. They were nice, grills. And based on because it's a slant, the fat and grease comes out. And so it's supposed to make a healthier hamburger. Pretty good, and you can make a panini. I never did the panini, but I have I pretty much did everything else on that, but not panini. So that's a good product. But back in the 90s, they fought each other. They didn't really like each other back then. So they fought each other, but somehow they entered into a like-kind exchange transaction, believe it or not. So again, in this scenario, again, remember the equation is always going to be amount realized, which is going to be the consideration you're receiving, and the bottom number adjusted basis. That's the basis of what you're giving up. Again, that's true for both cases. I'll show you the answer in a little bit. But again, we're going to walk through this again so you guys can see how it works. Now, one thing I want to emphasize regarding like-kind exchanges, like-kind exchanges used to be available for all fixed assets, pretty much, and investments. So that included machinery, equipment, furniture, as long as it's like-kind. So under the old rules for like-kind exchanges, it had to be you're exchanging a computer for a computer. You're exchanging a desk for a desk. And even it was even very specific when it came to livestock. You're selling or you're exchanging a cow for a cow. It had to be the exact same, cow breed, whatever, and the same sex when it came to those type of exchanges. However, as part of the Tax Cuts and Jobs Act, they only made it applicable for realty. So it only applies to realty. Well, I guess truth be told on that, the more like kind exchanges are more common in real estate transactions than anything else. So I understand the move to that, but then in that respect, that means if they make an exchange and it's not realty, it's a taxable event. Just keep that in mind. If they're making an exchange and it doesn't involve realty, it's a taxable event. And it's again the difference between the fair market value of the property that you're receiving minus the adjusted basis. That's going to be a taxable event, even if you don't receive cash. Keep that in mind. If it's a fixed asset other than realty, you're going to recognize a gain. Unfortunately, and we'll apply it in this particular scenario, so you guys can see how it works. But in this case, let's walk through George F's scenario first. So George F exchanged a property, his adjusted basis, the basis of the property he's giving up, that's 400,000. So when we're trying to determine if George is going to recognize any gain or loss, what happened? What was that? Did you guys see that? It was weird. It just froze.
Yeah, I saw it. It was strange. It's gone.
Yeah, that was weird. Wow. This office is haunted. Something is wrong with this office. I'm kidding. I'm kidding. Um, I would tell my staff that this office is haunted. They laugh. Little do they know. I'm kidding. I'm kidding. It's not haunted. All right. So the adjusted basis is the $400,000. Again, that's going to be the bottom number of George F's equation. The adjusted basis, $400,000. George is receiving Evander's property, right? So his consideration is the fair market value of Evander's property. So the top number for George is going to be 700,000 minus what else is happening here? The cash that George is paying Evander. So think about this. What consideration is George receiving logically or from a business standpoint? His consideration is the fair market value of Evander's property, 700,000 minus $100,000 cash that he's paying. Think of that as a selling expense. So his net consideration is $600,000, right? You guys see that 700,000 minus 100,000 equals $600,000. So 600,000 minus 400,000, there's a gain, right? There's a $200,000 realized gain, and that's for George. Again, I'll show you the answer once we walk through both of them in a bit. Evander, on the other hand, Evander's getting George's property. Evander's basis is 300,000. So that's the bottom number. The top number is the consideration that he's receiving. Evander's getting George's property that's worth 600,000, right? Plus $100,000. So what is the total consideration that Evander's receiving? Again, think of it logically. He's getting no, not 400,000. Again, he's getting $600,000, the fair value of the it's the fair value of George's property, 600,000, right? Oh yeah, you went a step ahead. You went a step ahead. But yeah, you're on the right track, but you went a step ahead. His consideration is 600,000 plus 100,000, right? $100,000 total consideration minus his adjusted basis is 300,000, and as Matt said, the realized gain is 400,000, right? 700,000 minus 300,000 equals $400,000, right? All right. What happens next, Matt? Maybe I should ask this question. Does Evander recognize that gain or any gain? Why? We already determined that well, actually, I didn't even give you the answer yet. But does Evander recognize a gain? Why? Under these facts?
Yes.
Yes, because
You
there's
received the boot.
there's boot. The cash receive is a triggering event. The $100,000 or the $400,000 realized gain, whichever is less, is the taxable. That's going to be the taxable transaction. So $100,000 will be taxable to Evander. Okay, let's I want to show you the answer so you guys can see. All right, so again, these solutions are space. Give me a second. There it is. There it is. Section 121, we already walked through this. Again, take a look at the solutions. Here are the like-kind exchange transaction, George and Evander. Pretty straightforward. Again, $200,000, no recognized gain because George did not receive boot, right? Evander, on the other hand, there was a realized gain of a $400,000, but he recognized $100,000 in recognized gain, right? Because that's the boot he received. My explanation for the bottom: the gain recognizes the lesser of boot received, the realized gain. In this case, boot is less. That's what gets recognized. We also gotta take it to the next step. The next step is, again, what are the questions? What is the realized gain? We answered that question in both. What is the recognized gain? We answer that question in both. And in terms of the treatment of what is the character of the gain, I'm not going to give you that answer yet. But what's the fourth question? That's the basis, right? So now we got to see the basis of the new property. Generally, it's a carryover basis, except it's not. But this is the equation. Think of base, B-A-S-E. Base, you start out with the basis of the old property, add any gain recognized. In this case, there's nothing. Add boot paid, $100,000. Subtract cash received. That equals the basis of the new property. Because maybe let me give you a journal entry. If I were to do a journal entry, we got new asset, right? Ignoring accumulated depreciation. Well, actually, I won't ignore accumulated depreciation. I want you guys to see how it would look. Wait, new asset. Of course, the asset is not going to be new asset. Actually, let me label this. This is going to be new. How about realty? New. So think of it this way. Again, if you look at it, even without the depreciation, let me move the depreciation out for a second. But as the credit side is going to be realty owed, right? And what else do you have on the credit side? Cash paid, right? And then if there's any losses, that would be on the debit side, but there isn't. So in this case, if you look at it this way, again, by equation, we know this number, right? We know this number, right? We don't know this number, right? Think of what we just did on top. If you understand debits and credits, again, these are your debits, these are your credits, right? This is what we're giving up, right? The cash, it's a credit. The realty is a credit because that's what you're giving up. So what we're looking for is this number, right? The debit. That's how we came up to the 500,000. 400,000 is the basis of the old property, and $100,000 is the credit, that the cash that they're giving up. So the missing number over here, it's a $500,000. Let me do the same thing for what we have over here on this side. Again, for those of you who like debits and credits, which should be everybody here. All right, so over here, similar equation here. Again, we have cash. Oh, and actually, no. The basis of the old property, that's stated, right? Gain recognized. So we have gain, right? Gain recognized, that's, refresh my memory. I forget this. I'm not a real accountant. I am a real accountant. I'm kidding. But let's say I wasn't a real accountant. In terms of debits and credits, are revenues increased with a credit or a debit? What do you guys?
Credit.
Let me give you something else to help you think about this. You're dead if you don't understand your debits and credits. Debits to increase expenses, assets, and dividends. And the other mnemonic is CLOR. Credits to increase liabilities, owner's equity, and revenue. So let me ask you the question again. Revenues, that's increased with a credit, right? Right? That's the answer. So over here we got a credit. Gains are revenue, sources of revenue, right? So we have a credit. And we have a cash here, right? They receive cash, right? So think about this for a second. And maybe if you understand the journal entries, this would help you understand this equation. Again, basis of the old property, add gain recognized, those are my credits, right? Add boot paid or cash paid. On the previous example, that was the credit to cash, nothing here, right? Subtract boot received. So think of it this way. I'm adding these two numbers. I'm subtracting my debit. That should give me my missing number, the basis of the new property. It'll work. Depending on how you look at it, it's if you understand debits and credits, it would help. If you don't like debits and credits, then just use the equation. Either way, you would have to know how to, do the basis of the new property. Now, let me ask you another question. Now, I mentioned to you that this is realty for realty, and that qualifies for a like-kind exchange under the new rules. But what if it wasn't? What if they were exchanging a car for a car? Or they were exchanging something that's not realty, machinery for machinery. What happened then? Yeah, again, in this case, it's again, a like-kind exchanges, the triggering event is the taxable boot. If there's boot received, that triggers a taxable event. Again, that only applies to like-kind exchanges. Like-kind exchanges only applies to realty. So if it wasn't realty, if they were selling other or exchanging other fixed assets, what would happen to George? Think about that for a second. George is exchanging, let's say, furniture for furniture, or whatever, the machinery for machinery, equipment for equipment. What would happen with George? George would recognize the $200,000 gain. You guys understand that, right? Because it's not realty. Again, it would be the same if he sold it for cash, because he still has to claim the fair market value of what he received minus the cash that he paid, and then you get to subtract your adjusted basis. He would have a recognized gain of $200,000. In this case, Evander, on the other hand, his recognized gain would be 400,000. Doesn't matter the again, that rule, the Section 1031 rule, that's specific to like-kind exchanges, the lesser of boot receive or realized gain. If like-kind exchanges only applies to realty, what about the other exchanges? Even though I told you that most like-kind exchanges involved are not, I mean, are realty and are not other fixed assets. But what if you do have, other fixed assets? You're gonna have taxable event. I think that was the intended consequence or the intended result. Remember how I said that every tax bill is going to have some source of revenue in there? This is the source of revenue. So again, it's not an unintended consequences. Again, it was by design. I'm pretty sure they already thought about this. By they, I mean Congress already factored that in, and they figured, well, that's going to be a source of revenue, meaning they're going to make more taxable transactions than not. The other side of it is going to push more people to still engage in exchanges or transactions, so to speak, but more transactions heavy on realty. So it actually sort of indirectly they're trying to influence the real estate market indirectly. And that remains to be seen if this is going to affect the real estate market. This particular provision, it will have effect the other side, the other way, but not, in terms of maybe, I'm not sure yet. The numbers are haven't been determined yet. Any questions or comments on like-kind exchanges? No? At all? Any questions or comments about George Foreman and Evander Holyfield? And them? The machinery is not like kind. That's considered boot and that well, sort of. It may trigger a taxable event. It's yeah, it may trigger it may it's going to the exchange of the so if I'm understanding the transaction, realty by itself is not going to be all real estate. Everybody understands that, right? A portion of the real estate is going to be, yeah, like you alluded to. There's going to be improvements that may be affixed to the realty or not. Windows that that may be well, that's going to be part of an AC unit. AC unit would not be a 1250 asset. By the way, 1250 is realty. AC unit would be a 1245 asset. So that would be, if you think about that, if it's a whole transaction itself, you have to attribute a certain portion of the value to the AC unit. The AC unit is like you're selling the AC unit. Think of it that way. The AC unit would trigger a taxable event. So you would have to do cost segregation, allocate a specific cost and specific value allocation, and whatever is attributable to the AC unit, because AC, again, think we would agree that AC will not be a real estate. It's not real estate. It's a 1245 asset that would trigger a taxable event. But again, even in that case, under the old rules, that would be considered that would trigger a taxable event anyway. Under the old rule, because that would be considered as you're receiving boot. You're receiving something other than a like-kind exchange. And I'm actually glad that you asked that question. There's several handouts that I have on Brightspace, and there's even a couple on like-kind exchanges. Give me a second to pull the slides. No, that's not it. Okay, what I'm going to show you is going to be a PDF file. Um, okay, this PDF file is on Brightspace. Again, this is a very good handout. The book mentioned something similar to this. It's not showing up. Oh, there it is. There it is. Again, take a look at this. This should be in there. Again, something similar to this is on Brightspace, and this actually walks you through. If you look at the bottom, the complex like-kind exchange, that's what you're referring to, the complex like-kind exchange. So that involves boot. And over here, now I did mention that boot is cash. It is cash for most purposes. In accounting, boot is cash. However, in tax purposes, it wasn't always just cash. And like-kind exchanges, it would be so. Let's say I'm exchanging same set of facts. There's exchanging a realty for realty. Doesn't matter. It doesn't have to be the exact same realty. It can be a parking lot for a warehouse. That's a like-kind exchange. But if as long as it's realty is realty, it's pretty lenient. But in that case, let's say the warehouse had 1245 assets. Well, the 1245 assets, if you notice right here, you see the section where it has non-like-kind exchange property? That's considered boot. So in any, even under the old rules, the fact that you're exchanging a 1250 asset realty that has 1245 assets in it, the 1245 assets would trigger a taxable event because that's considered boot. You'll walk through the same steps, but in this fact pattern, let's actually say, again, take a look at this. This is a good, table. It walks you through everything. It tells you what I just explained. Now let's go back to this, equation. So again, using what Matt just mentioned, here it is. But let's just say instead of cash paid, the 700,000, it's the $700,000. Well, actually $600,000. It's actually, if you think about this for a second, what is the total consideration Evander is receiving? He's getting the fair market value, if you think about it, $700,000, right? Now let's change this a little bit. Let's just say this was not cash paid. This was AC, AC, right? Which would be food. Same thing. Nothing. Well, oh, sorry. I gotta put. It doesn't change anything, right? So then over here, again, instead of him receiving food, he's receiving an AC. I'm actually glad that you asked me that question because it doesn't change the answer here. It's still a like-kind exchange, but that AC unit, because that's not like-kind property, that's considered boot. That's going to trigger a taxable event. So if you think about it, that's actually more common. Maybe I should have put that in there instead of the cash, but it will result in the same thing, same fact pattern, same result. But even if you take it a step further, and the handout even takes it a step further, now you got to figure out the basis of the AC. Hmm. And that's a bit more complicated too. So the basis of the AC would actually be $100,000, maybe. In that case, it's actually a bit more complicated in that case. because you have to walk through a similar step here. It's a bit weird. Yeah, yeah, exactly. You would need a tax professional for that. It's not as an easy answer. And again, there are a lot of individuals that understand how like-kind exchanges work. I mean, believe it or not, I'm still learning it. And I've been practicing for years. Like-kind exchanges do change a lot. And in terms of the real estate industry, there are real estate professionals that I know that understand like-kind exchanges, but in terms of the tax rules, in terms of like kind of exchanges, that's where I come in. That's where I would explain this to them. They may understand the industry in terms of the market and the fluctuations and prices. They may understand that better than I would understand it because that's their industry. But in terms of the actual tax law, this is my world, I guess. So this is what I understand, pretty good. But I still learning the like kind exchanges. I still learning, like I mentioned to you about does the like-kind exchange, because it's more tax law. I really want you to understand is when it comes to tax law, it's much more than just knowing how to do tax returns. Again, I also talked about representing people. I want you to be, at least understand that side of it, but it's more than that as well. I don't want you just to know how to do tax returns. Understand the impact of it. Understand, like I started, having these conversations. Well, how would this affect the real estate market now that it's limited to just real estate transactions? I want you to start thinking in that manner as well. Think of it in broader terms. How would certain tax bills affect the economy? What is this particular provision trying to influence? Because a lot of provision, that's what they're trying to do. They're trying to influence society to buy something or not, or to go to school, whatever it is. They're trying to influence society. I want you to also think of it in that manner as well, because it's not just doing tax returns. Honestly, doing tax returns can be boring. Understanding tax law, that's what makes it very interesting. Understanding the economics effect of tax law, of tax policy, that's what's really and I guess that's just the way I look at it. I'm sure you probably heard about, and this happens every election year, especially presidential elections. Did you hear that Biden has a tax bill in the works? You guys hear that? What if I told you that's been in the works even before Biden, was gonna before he was the nominee? Would you believe me then? What if I what if I told you that Tax Cuts and Jobs Act that was passed during Trump's administration, that was already brewing during Obama's administration? What if I told you that? A lot of these, yeah, and a lot. If you think about it, these bills are started and we talked about the legislative process. They start during legislation, but during the process. So they're going back and forth, Congress and the Senate and the House. We talked about how that works. So if you think about it, there are some bills that can even take years for it to fully develop to an actual law. And yeah, the Tax Cuts and Jobs Act, it was going to be tax reform regardless if there was a Republican or Democrat in office. Just keep that in mind. The president is the one that signs off on the bill at the end. It still has to go through Congress. So they're already talking about, even before they start talking about who they want to represent their party. They already knew what what they want to pass. So just think of it that way. So in terms of the Trump bill, I hate it when people say this is the Trump bill or this is the Obama bill. Well, not necessarily. This is a tax bill, and the tax bill has been brewing for years before they even came in office. I'm not knocking them and not saying that presidents don't have influence, and the legislators they do. So they do have some influence, but it's all on the legislators. By the way, this is an election year, so make sure you vote November or don't vote. If you can vote, vote. Well, what was that? Oh yeah, that's again that's true. State elections, yeah, state elections. Vote for the local alderperson, alderman, alderwoman. Yeah, they actually those affect you more. Because that's more closer to home, so to speak. So yeah, it's good to be involved in politics. I know some people don't like talking politics, quote unquote. I never understood that part of it. You have to talk about politics. So there's going to be people that disagree with you. That's the whole point of it. That's the whole point of having these dialogues, discussions. you have to be open to hearing the other side's point of view. But I guess just nowadays, and that's on both sides of it. It doesn't seem, if you think about it, even again, I'm not picking on this particular administration. I'm going to say it's the last two Congress, 115 and 114. They haven't really passed much in terms of tax bills. Again, the CARES Act, that was very useful, but I'm thinking that may have been only like the third tax bill that I can think of, and the second tax bill wasn't even a tax bill at all. That was more. I mean, it was a tax bill, but there was no revenue in it. It was more. It's the Taxpayers First Act that you probably heard about it. The Taxpayers First Act, that was more of enhancing the taxpayers' rights. Again, hence the term Taxpayers First Act. That was passed last year. I do like it. I do, agree with it. But again, there was nothing specific on tax deduction, tax credits, or anything like that. The CARES Act that just passed, I like that bill because that actually did provide relief and that was a bipartisan bill that did provide relief for a lot of businesses. They made the net operating loss rules flexible, which would give those taxpayers indirectly or directly access to cash. Directly, if they're getting refunds, if they're carrying it back 5 years, indirectly, if they're electing to carrying it forward, indefinitely. Again, 100% of it, or it can be used up to 100% of taxable income. Yeah, start thinking of when aside from after today's or after this summer, even if you don't see me ever again, and I do want you to think about taxes, as it applies in your world, as it applies to everything. And don't just think about the tax world as just doing tax returns. It's much more than that. You got to really understand the policy and how that affects people. That's what really understanding tax law is all about. That's what I want you guys to be. I want you guys to have conversation with your friends and family about how this policy affects this person or this particular business. That those are the conversations that I want to hear. If you're not already having them. Okay. That's all that I have for like kind exchange on this side. Let's move on to no questions on like kind exchanges. Any other questions? We do have that one problem we're gonna do. Um, I gotta stop drinking pop. That's not healthy. But I feel like I need it today. Like I need to be alert, and I don't drink coffee much. I'm not much of a coffee drinker. I will not drink. I have tried those power drinks. The what do you call those? The Monster drinks and the Red Bull. I've tried that. I don't know. There's a warning for a reason. That's all that I can say about that. I prefer drinking Coke if I need something to pick me up, and that's what I'm gonna be doing today. So, any questions on like kind exchanges? No. All right. So we talked about fixed assets and selling fixed assets. Again, I'm going to walk you through this problem again and the sale of fixed assets. Then we're going to do the problems in the book, and then we're going to that should be it. All right. So the like kind exchange problem. Hold on, that's showing up. Like kind exchange problem. That's the one we just did. Okay, that's it. The next one. Okay, we already did these two. I'm not gonna go over those today. This is involuntary conversion under Section 1033. Look in your notes for that one. Installment sale, again, pretty basic equation. I'm not gonna test you on either one of those, but I do want you to understand because it can save your clients a lot of money, or just understand what the whole point of it. In both scenarios, if you think about this, the first one, involuntary conversion, it's allowing taxpayers time to replace the property they lost due to an involuntary conversion. As long as they didn't keep any of the money, then it's not a taxable event. That's the whole point of this one. The installment sale, that's, if you think about it, that's more of a true cash method of accounting. What is a cash method of accounting? You recognize income when you receive it. This is it. The installment sale, if you think about it, you sold in this case land 1 year, but you're receiving payments within in 3 years, right? So you're not going to recognize all the gain the first year. You're going to recognize it as you receive it. Again, this is favors taxpayers. Again, you can elect out of it, but there's really I guess there is some benefits, but better to use it than not. In some cases, it's good to elect out of it. Remember, 1250 and 1245 rules still apply here. Um, Here, this is we're gonna do number 4 and this one. We're gonna do these two, and then we're gonna do the problems in the book. Okay, Jay Frazier. Anybody know who he is? Nobody? Anybody? He was also a boxer back in the day. But he bought music equipment costing 180,000 using his recording studio. There was a depreciation of $70,000. Even though I'm not telling you what it is, can you determine what type of acid I'm talking about? Let's say I don't have 1231 acid. Let's say this was an actual problem, and this was blank. You'll be able to ascertain that this a fixed acid, right? You'll be able to determine that this is a fixed acid. Why is it a fixed acid? Because it has depreciation. And then when you think of fixed acid, you should think about what's a 1231 acid. Well, wait a minute. When we're talking about 1231, I know that has something to do with depreciation. Remember, I'm not going to test you on 1250 real estate depreciation. I do want you to understand that, but I'm going to test you more on 1245 rules. 1245, up to the $70,000 depreciation, that's ordinary income, up to that amount. And whatever left over is treated as a 1231 gain. That may be a capital gain. Remember, 1245 does not apply to losses. Like in the last one, is going to be a loss. So we have 180 minus 70,000. Adjusted basis is 110,000. You guys got that, right? $70,000 represents depreciation. So there's 3 different fact patterns. They sold it for 150, they sold it for 200, or they sold it for 80,000. And I want you to think about the different gains and also the character of the gain. So this is the one we went over last week. Okay, here we go. All right, so here it is. Sorry, there it is. There's the answer. Okay, first scenario. Okay, again, they sold it for 150. Again, the adjusted basis was 110,000. Realized gain was 50,000. All
I still
recognized,
see
by
the
the
old one.
way. By the way, the realized gain of $40,000, it's all recognized. The question that you have to ask is, how is that gain treated? Again, letter A, it's all recognized. Under all these fact patterns, it's going to be recognized. Even on the loss, it's still going to be recognized. So keep that in mind. It's not if it's not going to be recognized. They're selling fixed assets. It's going to be recognized. The question is, what's the character of that recognized gain or loss? First one, realized gain of $40,000. It's all recognized, right? So $40,000. Remember, I said up to the depreciation of $70,000. That's ordinary income. So here's my explanation. Because realized gain is less than the accumulated depreciation, all gain is recaptured as ordinary income under 1245. It's treated as ordinary income. So again, it's taxed at the ordinary rates. So if it's taxed at 22%, then if again your wages are taxed at 22%, so would this be taxed at the same rate? That's what it means that it's ordinary income. It's going to be taxed at the same rates as everything else. Second scenario, they sold it for 200,000. Remember, I said up to $70,000 is ordinary income. So in this case, there's a realized gain of $90,000. It's all recognized. Ask ourselves, how is this recognized gain of $90,000 treated? Well, 70,000 of that recognized $90,000 gain is ordinary income. $20,000 is 1231 gain. So here's my explanation. The total depreciation is recaptured as ordinary income. That's $70,000. The excess is 1231 gain. And assuming that that's it, there's no look back provision, it's a long term capital gain. That's the character. The last scenario, they sold it at a loss. Remember, this you do recognize this loss, the law, because it is a recognized loss. You don't recognize loss on the sale of personal use asset. So this is a $30,000 realized loss. It's also recognized. Do we apply the recapture rules under 1245 on losses? No. So in this case, it does not apply to losses. Any result is a total loss. 1231 losses are treated as ordinary losses. So it's an ordinary loss. It's fully deductible. Remember, capital losses are limited to $3,000, right? This is ordinary. You can deduct the full amount. This has the best of both worlds. Now, let's walk through one of them, the next one. We're going to walk through the next one, and then we're going to transition to the problems in the book. Wait, no, this isn't it. The next one. The problem in the book are very similar to, where are we at? Here we are. No, that's not it. All right, the next, there it is. All right, the last problem in this series of problems is the last one. Now this one, again, I want you to walk through each one, selling price, 40, 26, and so forth. Now, let's do the computations quickly on each one. 68,000 minus 32,000, what's the adjusted basis real quick? Somebody with the calculator, or not? Matt, I'm counting on you. You're the human calculator. Or somebody else. 68 minus 32 equals what?
36,000.
Thank you. $36,000. So I'm going to use $36,000, the difference between $40,000 and $36,000. That's the realized gain. Okay. Again, right now I'm walking you through this. I'm going to show you the answer in a little bit. 25 minus 5,000. What is that? 20,000, right? So 26,000 minus 20,000. That's the realized gain, right? And then over here, 40,000 minus 15,000. What is that? Oh, and I'll give you the answer. 40,000 minus 25,000. 15,000, right? So 5,000 minus 15,000, you have a loss.
Mm-hmm.
All right, so here's the answer. Well, this, because it's several multiple transactions, there you got to net all of them out, right? So again, the first one, as I mentioned, there was a realized gain of $4,000. All of it, up to the depreciation that they claim is ordinary income, right? Everybody okay with this one? Okay, next one. 26,000 minus 20,000. There's a realized gain of 6,000, and this is how it's going to be. Again, it's all recognized, but it's going to be taxed. 5,000 ordinary income. 1231, it's 1231 gain. We don't know what it is. Let's assume that's all it was. The van transaction did not exist. They only sold the printer and the copier. You don't have a $9,000 loss or a $10,000 loss here. What would be the outcome here? Again, the van, they didn't sell the van. What would be the outcome here? $9,000 is what? Ordinary income, right? $1,000 is a 1231 gain, which would be taxed at capital gain rates, right? You guys get that part of it, right? But in this case, there's even more, because you got to net the 1231 gains with the 1231 losses. So we have a 1231 gain, but the last one gave you a $10,000 1231 loss. You have a $9,000 ordinary loss, right? 1231 gain minus the $10,000 1231 loss, $9,000 loss, right? Ordinary.
Where would you then deduct an ordinary loss, since you said it's not considered a capital loss?
What would you deduct it?
Yeah.
Well, there's no line on the tax return to deduct it. Are you sure?
I'm trying to think. I'm sure there is.
Okay.
Because I know that capital losses is for AGI.
Well, okay.
And that's maxed out at 3,000. Would you also make an ordinary income loss for AGI?
Oh, so your question is it a deduction for AGI or from AGI? That's your question?
Is it a...
Quick answer. The only deductions from AGI are standard deduction and itemized deduction.
So it has to be 4.
It has to be 4.
Okay.
It has to be 4.
And you can just deduct the full amount?
You can deduct the full amount, yes.
That's a lot. Okay.
Yeah, it's very good. So I think I thought the question was where in terms of the form. But then I'll show you the form. Well, here's the form. I'm not going to show
Oh
you.
yeah, no, my question is more like where in the process. So yeah, for AGI
Well,
makes
it's
sense.
going to be on form 4797. That's where you would do the computations. And then that eventually would flow on the 1040. It's going to be on schedule 1. They just changed this. That's what I'm thinking. It's going to eventually flow on schedule 1, which eventually flow on schedule on 1040. But it starts off on 4797. Let me see schedule 1. Let me share this what I'm looking at right now. Okay, I'm actually glad that you asked that question. That way you guys can see. All right, this is schedule 1, which is some of again the additional schedule that you would fill out. Um, Pretty much everybody's going to fill this out. You know, do you see where where it would go? You guys, you see it? Line 4.
Yeah.
That's where it would go. Actually, in this case, it would be 0 because it nets to 0. $9,000 ordinary income, $9,000 ordinary loss. It's going to be 0, but you still have to figure out 4797. Again, all the information is here. Oh, I'm actually glad that you asked that question. So, all right, go back to where I was at. All right, with this scenario, let's go back to the other fact pattern. Remember how I said, what if the van was not sold? Then we have $1,000 gain. So the $9,000 ordinary 1245 loss, that's going to be part of the 4797. It's going to be on that. It's going to be on the whole transactions are going to appear on form 4797. Once you do all the computations, you're going to see a $9,000 gain on the bottom, and that's going to flow through on the schedule 1, which will flow through on 1040. 1231. This is a 1231 gain. That's still going to be on form 4797, assuming that was it. How is this gain treated? Remember, the 1231 has the best of both worlds. Losses are ordinary, right? Gains are what? You should know the answer to this. Our gains are capital, right? Where do we report capital gains here? Hannah, where do you think we would report capital gains? I know you know the answer to this one.
I hope I do. For
What
AGI?
schedule? It's going to be for AGI, but what schedule?
The one we just looked at?
Anybody have an answer for this? It's not Schedule C, which Schedule C that's self-employed. Let me give you the sections, give you a refresher. Schedule A is for itemized deductions, right? Schedule B is for interest and dividends in excess of $1,500, right? Schedule C is for self-employment activities. Yeah, I forgot what Schedule D was for. Anybody know? Capital gains and losses, right? So where would the $1,000 finally appear? On Schedule D. Eventually, it's gonna be on form 4797. If there's a 1231 gain, that's gonna be taxed as capital gain. The $1,000 is gonna find its way to Schedule D, and then it's gonna do what it does on Schedule D. That's what I wanted you to think, like where would it go? Because it's good to understand the theory, but at the end of it, when you're doing tax returns, I want you to see the finished product of the tax return. I want you to see the return. If those numbers do not make sense, they're not flowing through on the specific forms, then it could be something that's going on with the tax software. Speaking of which, so this year I switched over to a new tax software. So there's quite a learning curve that I've experienced in since the beginning of the tax season. Uh, but and I even told my staff this, but the result is always the same when you're reviewing the tax return. When you're doing the tax return, before you submit it to me to look at it, look at the 1040 to see if the numbers populated, if it makes sense to you, and make sure you clear all the diagnostics. So it's the same as anything else. But yeah, just like anything else, you get a new system. It helps. It's a learning curve. All right. Any questions on this problem? If not, we can do the other problem. All right. Let's do vital source. I tell you what. 39 is a good problem. I don't want to do this one yet. Matt, I think this is the one you wanted to do, right? Matt, was that you or was that Dan? Dan, did you want to do this one? Or maybe that's. Oh.
I don't recall specifically saying, but
All right, I think I'm just picking on you. Yeah, I don't know what was it. Where was it? Property transactions 17. But now we'll go over this one. But I think the 1245 rules are am I well? I guess they're both. I would guess if you would deal with more people just outright selling fixed assets than exchanges. That's why I think understanding the depreciation recapture rules is a bit more important. It's all important, but I think because you're going to deal with more outright sales, that's why you need to understand this first. All right, so let's. I got the answers for these, but I want to walk you through these quick. Again, we did 34. Remember how we did it? Because there was losses in the last 5 years. In essence, 1833 plus 42. What was that? Like 90. What was it? 90 something thousand, right? In essence, this $90,000 has to be recaptured as ordinary income first before any of it is 1231 gain in its capital. That's the one we went over in the last session. 36, 37. They're all pretty good, problems. Again, cost $100,000 minus $62,000. That's the basis, right? Forklift 35,000 minus 23,000. That's the basis, and then 87,000 minus $34,000. That's the basis, and then we have 85,000, $5,000, $60,000 in terms of the loss. It sounds like I don't remember if I gave you the answer to this. I think I did. Um, yeah, I did give you the answer to this. This should be posted on Brightspace. This particular problem, well, the next series of problems. Again, the way I posted it in the same format that I have the other problems. So you should see the spreadsheet that I'm going to show you right now. Again, I'm pretty sure this is what I posted. I don't think I posted what the book has. I'll show you the book answer, but I like this presentation better. Well, it's just a preference, I guess. All right, you guys see the answers? Again, in terms of the bases, we talked about that before. Again, this is the first one, 36, problem 36. They sold it for $85,000. The basis was $38,000. Again, the 40 up to the depreciation claim is treated as ordinary income. So in this case, $47,000 is recaptured as ordinary income. Now, the next fact pattern, there was a $12,000 base, but he sold it for $5,000. So it goes straight to a 1231 loss. No recapture provisions here, right? And then the last one, again, $60,000. He sold it for, or the basis was $53,000. There was a gain of $7,000. All of it is ordinary income. So over here, what I have here, this is again similar to what I did in my previous problem. So I grouped up my 1245 gains or ordinary income. There's no 1245 losses. So 47,000 from scenario one, from the rack, and $7,000 from the bin. Total is $54,000 ordinary income, right? There's a 1231 and this a 1231 loss here, right? Of $7,000. So the answer to letter A, $54,000 is ordinary income under 1245. $7,000 is the ordinary loss under section 1231. Pretty straightforward, right? Now the question letter B, if we go back to the book, the letter B, go back to the book. Again, I like these because they all walk you through different scenarios. Letter B in this one. It's. I don't even know why they ask you this way. Assuming Sienna had no unrecaptured net 31 losses in the last 5 years, not that's kind of like saying, okay, that's good to know, right? What is the result? Does it change anything in letter A? No, right? It doesn't change anything in letter A. Remember, the look back provision is if you look back and there's any 1231 losses in the last 5 years. Nothing there, then you just continue with the 1231 rules. So again, my explanation, Because there are no prior 1231 losses, the look back provisions do not apply. Therefore, Section 1231 loss is ordinary. Huh. So that was it, pretty much. And even if it wasn't, it's still ordinary. You'll see right now. Gets a bit tricky. All right, next question. We're doing 37. Get same fact pattern. Give you a couple seconds. It takes a second. Okay, again, same thing. Oh, letter A. $100,000 cost minus $100,000. What is the basis here? 0. What is the gain? $145,000. How was that gain treated? Well, I think you can already figure out what's going to happen here, right? $100,000 is recaptured ordinary income. The difference, $45,000, is a 1231 gain. Keep that in mind. Same again over here, 35 minus 23. They sold it for $3,000. That's a 1231 loss, right? Again, $87,000 minus $31,000. What does that equal? Anybody? You're gonna have sold it for $60,000. There's a gain there. Now, we're gonna figure out what happens in each scenario. Letter B is what I want to direct your attention here to, and we'll discuss that in a few minutes. Letter B, independently, there's a $5,000 non-recapture losses. In other words, in the last 5 years, they claim a 1231 loss. That's relevant. Okay, let's go over the answer real quick. Okay, this is 37. Okay, 37, as you see, it's pretty straightforward. Again, the first one I gave you the start of the answer for the first one. $145,000. It's all recognized. $100,000 is ordinary income, right? 1231 gain is $45,000. Assuming that was it, then it's all capital, right? You guys see that, right? Again, assuming that was it, the $45,000 is capital, right? Now let's just take it a step further. Let's say, again, assuming that they just sold the rack. They sold it, and then there's a $45,000 1231 gain. And let's continue with letter B a little bit. There, in the last 5 years, they claimed a $5,000 loss. So before we even treat any of the $45,000 as capital, $5,000 is ordinary income. So in that scenario, $100,000 is ordinary income on the 1245, and then the $5,000 is ordinary income because they claim 1231 in the last 5 years, and then $40,000 would be treated as capital. So that's how that would work if that was the only transaction. I'm telling you that because I'm giving you a preview so you can understand the full scope of this transaction. Okay, so let's continue on. $3,000 for the next transaction. Remember I told you they sold it at a loss. This was a 1231 loss. 1245 rules do not apply to losses, right? And then the bin, I told you there was a small gain, right? $60,000 minus $56,000. It's all ordinary income, right? Again, over here is how I group my transactions by transaction types. 1245 recapture rules. There was only 2. Again, $100,000 from the first transaction, $4,000 from the second or the third transaction. $104,000 is ordinary income. Again, 45,000, 1231 gain, netted against the 1231 loss of $9,000. There's a $36,000 1231 gain. Just on those facts alone, this is how it's going to be treated. $104,000 is ordinary income under Section 1245. $36,000 is 1231 gain, treated as capital. Everybody okay with that part, right? Well, let's take it a step further. And letter B is asking us, what would happen if they did have a 1231 loss in the last 5 years? So here's my answer. Because there were non-recaptured losses of $5,000, $5,000 of the $36,000 is the 1231 gain is ordinary income. You guys get that, right? Of the $36,000 1231 gain, $5,000 is ordinary. So you got 104 ordinary at 1245, and then $5,000 of this 1231 gain ordinary because they have a loss in the last 5 years. That's ordinary income. The excess $31,000 will be treated as a capital gain. I like these two problems because it applies the look back provisions as well as everything the netting procedures. Very cumulative, very comprehensive. Any questions with this problem? No questions? All right, let's do the last one. All right, take a look. Okay, this one's similar fact pattern. Hold on. Similar fact pattern here. Again, first one, 110,000 minus 70,000. You have your basis. Again, do the same thing for each one. 45,000 minus 21,000. And go to 15,000. Again, 97,000 minus 31,000. We had to figure out if there's a gain or loss there. And then we have letter B, independent fact, similar to what we had in 37. All right, let's take a look at the answer. Again, this answer is on Brightspace. So we have, again, the first fact pattern against $55,000. Remember, up to the accumulated depreciation is ordinary income on 1245, so it's all ordinary income on the 1245. In this case, the second scenario of the forklift, they sold it at a loss. It's ordinary loss. Well, we don't know if it's ordinary. Well, it should be ordinary. It is ordinary. 1231 loss, right? The bin, they also sold it at a 1231 loss. Again, same thing I have here. I grouped them by category, right? 1245. There's only one transaction that resulted in a 1245 gain, right? And then we have 1231 losses. 1231 gain is ordinary income and $15,000 ordinary loss, right? So letter B helps you understand it even taking it a step further. So if you look at letter B, it's saying in the last 5 years, there was a $6,000 loss. Well, the look back provisions, if you remember, if you look at the table, that only applies to gains. Any recapture provisions only apply to gains. So here's my answer. Because there were no current net losses, look back provisions do not apply. Ordinary. So again, 1231 is ordinary income under 1245. I mean, $15,000 is 1245 income, ordinary income under 1245. $15,000 is ordinary loss under 1231. Any questions with this? Again, make sure you understand this. This will be on the final. Again, go through the problems. The last problem I want to go through, and I'm going to give you the answer. But I don't like the way they're answered. Well, it's the same fact pattern. Oh, wait, wrong one. Give me a second. I'm going to walk you through a couple of these, and then in terms of just the gain or loss, actually, I'll walk you through all of them in terms of the gain or loss. Realize. Where is it? Where is it? It's the one that had multiple transactions. Okay, let's just walk through a couple of these real quick. Again, they're pretty straightforward. So, as I was saying to do a spreadsheet, Yeah, I don't think I created a spreadsheet for this. All right, again, I'll do the first couple with you, and then we'll, I'll show you the answer. Um, Actually, I'll do the first three with you. All right, so the first one, again, with this one is it's one-sided. It's only focusing on one party. My problem would focus on similar to like the problem I gave you, George and Evander. You would have to do it for both parties. This one is just one-sided, but it gives you enough information. So think about this for a second. In the transaction, $12,000, it's what's being received plus the $4,000. Total consideration is $16,000, right? Right? Minus $7,000 basis of the old property. 16 minus 7 equals what? $9,000. How much do we recognize? Anybody? I'll give you a hint. I'll give you a hint. You guys see it?
4,000.
4,000.
$4,000. The lesser of boot received at a realized gain, it's $4,000. By the way, I'm not going to be that nice on the exam. I'm not going to be giving you hints. Well, there are going to be hints if you really see them, but I'm not going to be there. By the way, this is a hint. That would be too easy. This one's actually it's different because there's boot received. So he or she's getting $15,000 minus $2,000. Net consideration is $13,000. $13,000 minus $14,000. There's a loss there. None of it is recognized. Remember, like kind exchange it's a deferral of gain, and plus there's also boot paid, so none of it is recognized. I guess I can probably walk through all of them, and I'll show you the. Yeah, I'll walk you through all of them. Next one, letter C. Ha. This is actually pretty funny. Boot given $7,000. Boot received $500,000. He's paying more than what he's getting, right? So there's net boot giving of $6,500, right? So it's actually, if you look at it this way, the whole equation is $8,000 plus $500 plus $7,000. Quick way would be $8,000 minus the net boot paid, right? So $8,000 minus 6,500, right, equals 1,500 minus the $3,000. In that case, that's a loss, right? No loss are recognized. This is a gain recognition, deferral of gain recognition provision. Next one, 29,000 minus 15,000. There is a gain. There is a gain there, but it's not recognized because there's no boot received. Next fact pattern. $11,000 plus $1,000 total consideration received is $12,000 minus $10,000. There's a $2,000 realized gain. How much is recognized?
1,000.
Do you guys understand why, and not just because I'm highlighting it?
Yeah, because it's less than 2,000.
Because it's less than 2,000. Yes. So I turned off my phone today, and I haven't been taking any phone calls today. You guys know why, right? My phone, everybody keeps calling me. And here's the thing, like, and I don't know, clients give me their stuff yesterday, and then they ask me what's the status of it. Like, I don't know, and it upsets me sometimes because I'm like, you had a whole 7 months. I mean, 6 months. Pretty much yeah, you had close to 7 months to get all your stuff together, and now you're gonna rush me. I don't know. I'm venting today. Hope you guys. Like, no, I used to, but no, no. This on a case by case basis, yes. If somebody really needs it done, yes. But if it's a client, and I know that these clients are wait to the last minute, I'm like, no, dude, or whoever, you're going on extension. You give me the stuff, you're going on extension. I'm like, I'm not gonna stress myself out for that. And I tell them, look, we'll do an estimate. If it's something is due, we'll do the best estimate. File remember, extension is an extension to pay, extension to file, not an extension to pay. So I do remind clients of that. We gotta estimate what your tax will be, and let's estimate pay tax, and then go this is a tax return. Same process I would have done on April 15th as well. But the funny thing is, like, I had clients that I reached out to on April 15th, and I told them about it April 15th, and I don't know what is it. Somehow they thought that I'll still get it done on time, and I'm like, no, you're going on extension. You know, that's it. That's where I'm at right now, and that includes my return too, believe it or not. So I want to show you the answer to this. I wanted to create a spreadsheet, not the one that they have, but similar to the spreadsheet I have. How about this? I'm gonna let you guys do that spreadsheet. I'll show you what. Why is that blank? Hold on. Let me show you the spreadsheet that I'm referring to. In your own time, I'll show you the answer right now. But over the weekend, I want you to do for each scenario. I guess you can line them up this way. You know, something similar to this scenario A, B, C, and so forth. Group them that way. And I would do just add another like something like this. Oh crap! I noticed I changed the answer. So something like this. This would be. So let's move $100,000. Well, actually, what I'm trying to say, I'm going to change this. So if you put it something like this, and then it spells it out. So you see what I did here, right? Fair market value, what received, plus boot received, minus boot paid. That's your consideration, right? Minus adjusted basis, and so forth. Now, if you do something like this, and then you just copy and paste for each column, all you got to do is plug in the numbers. That's the what I want you to do over the break. And once you plug in the numbers, it will give you good practice to doing these type of problems. All right, I'm having a strange day today. Like seriously, now my cell phone just rebooted itself. This is like so weird. uh this is not my day today. Give me a second. All right, let me go back. Go back to what happened here. Why is it blank? I don't know why it's blank here. They're both blank. Let's go back to the problem. Yeah, if you look at the problem, I'm gonna. Well, this answer is the same answer as last session or the last textbook. Let me get the answer from the last semester. And it's the same problem. I'm gonna give you the solution, chapter 15. Again, I want you to do it at home. Set it up the way I've been setting it up with the spreadsheet I just showed you. Again, this is a what number was that again? You guys remember? It's one of the problems. That wasn't it. It's one that had is asking for a spreadsheet. It was like 30. That wasn't it. Oh, here's the form. If you want to take a look at the form. 39. Yeah, there it is. Here you go. There's your answer. Again, they wanted it as a. They wanted you to create a spreadsheet, but those are your answers. Let me just restart my phone. So those are the answers you're looking for. Let's walk through these. Again, I want you to set it up the way that I showed you, setting up in that format. That would at least give you practice on doing it step by step. Are these the same? Oh, these are the same numbers, right? The first one had a $4,000 gain. I think that's what we said, right? Now the only thing that I don't like is the way that they compute the new basis. Um, it's in my opinion, it's backwards, but you'll get the same answer. Don't do it this way, class. On the exam, do not do it this way because that sort of defies everything and it would really confuse you once you do intermediate accounting. By the way, this equation, the reason why I was showing you debits and credits, because you'll encounter something similar in intermediate accounting. Do not, it is the right, you'll get the right answer, but don't do it the way they're doing it. Do it the way I was doing it. Basis of the old property. Add gain recognized, right? Add cash paid, subtract cash received. If you do it that way, you'll get the same answer, $7,000. Again, I would prefer you do it my way than the way that they're doing it. Because again, that would help you when you transition into intermediate accounting if you do it my way. Again, because that's my way is more focused on debits and credits. This way works too. Again, next scenario, remember there's no loss recognized. Again, I don't like the way they're computing basis. It's a carryover basis if you think about it. 16,000, that's it. 16,000. If you look at it, it's again the last part is the part that I don't like. I don't like the way they compute it. You'll get the same answer. Letter C, $1,500,000 realized loss. Remember, there's no recognition of loss. The basis is $9,500. You'll get the same answer if you do it my way. Class, did I tell you to do it my way? Trust me, just do it. Compare it to the answer that I'm showing you. You'll get the same answer. Next, letter D. Realized gain is $14,000. There was no boot received, so everything is deferred, right? Yeah, pretty straightforward. Next one. There was a realized gain of $2,000. This is when they received the $1,000 boot. So again, the recognized gain is $1,000. Last one, realized loss of $3,000. It's all not recognized. They're doing a $17,000 will be the basis, carryover basis. Again, I want you to do these computations the way we've been doing it in class with the spreadsheet. Maybe I'll do it too with the spreadsheet. Yeah, this way. Do it this way. Again, set it up this way. All right, there it is. Again, yeah, if you set it up this way, it'll work. Right? You get the same answer. Any questions on like-kind exchanges? No questions at all? Any questions on anything else that we've covered so far? No? I don't know what to tell you guys. So because you're not asking any questions, does that mean you guys are ready? Yes. Yeah, right. Yeah, remember today's the second to last day that you get to see me. Remember, Monday we're gonna go over the practice quiz. Make sure you work on that over the break, or not break, over the weekend. That is due for grading purposes, and that does include everything that we're gonna cover. That's what we're gonna do first. Submit it before 5:30, and on Monday, first thing we're gonna do is gonna be that quiz, and then we're gonna do and that's gonna be it for property transactions. I do want to see you go through this answer, so I want somebody to take the lead and show me your solutions in this presentation format for the problem we just did. So somebody's going to take the lead on that. And then we're going to talk about tax credits and other taxes, but very light on that. We are going to talk about it. I'm not going to test you on that, but I do want you to be aware of tax credits and other tax. But again, that's going to be towards the end of the class. But yeah, you got 2 more sessions, and then you have your midterm. So a week from, or not midterm, final. A week from today, we're not going to meet. We are going to meet Monday, but a week from today, would be the last day you can take your final. The final is going to be available 2 days. It's going to be available next Tuesday and on Wednesday. I'll double check and make sure that the it's set up that way. So you will have it up until again, it would have to be submitted by 8:30. So time yourself. If you're timing yourself 3 hours, the full duration, then you're gonna have to get started at least by 5:30, no later than 5:30. Just think of it that way. If you're timing yourself, it'll take you 2 hours, then do it 2 hours before. Everybody's gonna have a different exam. In terms of preparing, use the midterm to help you prepare for the final. I'm sure I've said that several times. Use these problems that we went over in class to help you prepare for the final. Use the lecture notes, the problems in the book that we've covered. There's a lot of material out there. In terms of what to focus on, I already gave you an idea. I'll revisit that list on Monday session. But for those of you who weren't able to make it last session on Monday, try to if you can get notes from one of your classmates, great. If not, listen to the lecture. I do go over the list towards the end of class on what I'm gonna test you on. But just think of it. It's gonna be property transactions. It's gonna be like-kind exchanges, the 1231 transactions, and it's going to be the sale of personal residence. The property transaction, that's what you're going to see, and everything else is I gave you that list previously, and then the 40-point problem, that's the self-employment tax problem. Start reviewing your notes in the next few days. Start if you have any questions, make sure you ask me those questions on Monday. Monday will be the last day that I will be available for questions. Please do not schedule a meeting with me and after Monday and schedule during the virtual hours. I'm not going to be available. You can still schedule a meeting with me on Monday during the virtual hours. And if you have any questions, you can have ask the questions during class. But that would be it. Up until 8:30 next Monday, that would be the last day you'll see me until next semester maybe. Any questions? Anything else you guys want to talk about?
Did you just say? Oh, go for it. Mine's not great, but did you say we're gonna go over the quiz on Monday? Or did you just say the project?
Well, no, we're not gonna go over any of the projects. We're gonna go over
Okay, the quiz.
Well, funny. I'll talk about I'll talk about the research assignment. We will talk about the research assignment on Monday once everything is submitted. So I will talk about that, but I'm not going to spend that much time on it. It's just more of an overview, just
Yeah,
casual.
but then we'll
casual.
review the quiz.
And then we're going to review the quiz, and then we're
Okay.
going to. And as far as any new stuff, the new stuff is going to be tax credits and other taxes, chapters 12 and 13. I'm not going to test you on that, but it's good to know. It's good to know
Thanks.
to have that information, but I'm not going to test you on that new stuff. So up until today, so think of it this way: up until whatever we cover today, that's all fair game. But I've already highlighted on what I'm going to test you on specifically. But again, on Monday session, any new stuff that I cover Monday is not. I'm not going to test you on it. All right, Matt, did you have a question? What is your question?
Oh, you caught that too.
I figured it was 2016. I noticed that.
What is your question? All right, so I forgot to change that date. You know what? Thanks for catching that. Nah, never mind. Yeah, I guess they got married young. Well, believe it or not, in some states allow that. So yeah. Well, wait. With consent, of course, but generally speaking, doesn't it want to be required if it's you're a teenager? Yeah. I was not aware of that. Yeah, I was not. Yeah, it was. Yeah, it's. I don't know what to say about it. It's. Yeah, don't get any ideas about that. It's if you marry who you're gonna marry, hopefully that person's an adult. That's just my thoughts on it. That's the only thing I can say. Um, I think if you're a teenager and you're thinking of getting married, too young, in my opinion. That's just what I think. If you're thinking of getting married at 14, you haven't really lived life much. You have your whole world ahead of you. And also keep in mind, remember I had mentioned marriage is a partnership, right? I mentioned that. I even have these conversations with a lot of people, adults, trying to explain that concept to them, and for whatever reason, some people get upset about that. Like they don't seem to grasp the it's a legal form of a partnership. You have a partnership, and when I try to explain that to them, and we're talking about adults here, they don't get it. They don't want to get it. Imagine a child, imagine a teenager. You think they would really understand the true? I mean, in terms of it's a partnership now. You think they will understand the joint and severally liable aspect of it? And what about common law? Side of it, or community property states, more specific. Would they understand that? Yeah, I'm not saying I'm against it. I just have my reservations against getting married so young, I guess. That's just my thoughts on it. I mean, but there's always exceptions to the rule. There are people that are, mature for their age, and they know what they want when they're young, and they are mature, and they'll think about, stuff like that. But that's all that I can say about that, and I'll change the date maybe. Thanks for bringing that to my attention. So they got married as teenagers. Maybe I should change. No, I'm not gonna put that. I'll change the wording. Any other comments? Anything else? Nothing? Wow, we're leaving. We're ending 1:30. Are you sure you guys have no questions? Speak now or forever hold your peace. Well, until Monday. My network is down on my phone. This is weird. Maybe the weather. Let me restart it. All right, so I need a motion to adjourn. Anybody? Motion.
Motion.
All right, second.
Second.
All right, guys, don't forget to do work. You still got work to do over the weekend. The research assignment, also do your homework. Good luck, guys, and I'll see you guys on Monday.
Bye,
Thank you.
thanks.
Bye.
Bye.
Good night.
Good night.